Hello, ladies and gentlemen, and welcome back. Well, what a difference 24 hours makes in the markets. Of course, we've now rejected, at least at this stage at the time of recording, the most important level for 2022. Now we need to look at dumb money versus smart money. What is the flow? Where is Wall Street moving its market action? And of course, most importantly, what's exactly happening with interest rates in 2023? Well, we have some of the answers for that and also our thought process around the next couple of weeks, leading into one of the biggest options expirations we've ever seen. Trillions of dollars are at stake, so join us now as we cover it all together. See you soon. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. We've got the macro data, the lead indicators, the big news stories, and of course, the biggest key levels that you need to be watching right now in the markets coming up in today's show. But let's begin with some of the stories that we shared on our Twitter. Follow us at FX Evolution over on the Twitterverse. Let's talk firstly about credit default swaps. Of course, the biggest discussion we've had about a potential black swan that's in plain sight is got to be Credit Suisse. Credit default swaps, as you can see here throughout history of the global financial crisis all the ways to now, have been very significant, and we're starting to see new all-time highs for Credit Suisse. What does this mean? Well, it shows us that at least that banking institution is quite sick. But let's take a step back and have a look at what similarities in the past with some of these problems and now. Well, the biggest problem that we've had in the past has always been that we usually saw multiple banks doing poorly and credit default swaps rising. That was the case until just recently. Notice here things like UBS, Deutsche, BNP, Euro Financials, and if we look at Morgan Stanley, JP, and all the others, they're on the trajectory down, while Credit Suisse is on the trajectory up. Again, risk is getting bigger across the board here for this one. Another thing that we need to be thinking about is S&P 500 valuations. We brought this up on our weekend video. Always remember, if you're a longer term investor or even a longer term trader, something that you always like to do is buy forward valuations theoretically, but you want to buy them around, usually -1 standard deviation is a very good level. Will we get that again in 2022 into 2023? Well, we got close to that level here, November 30th, 17.64 at the time of pretty much around this recording. And you can see that some of the means and averages, we're getting back to some of those levels. Now, we talk a lot about dumb money versus smart money, and we also talk a lot about yields. And this was the biggest change in the last basically week and a half in markets. Notice the blue line here. This is the expectations of the Federal Reserve rate cut. Now, a lot of people think about the word pivot, and that's the discussion point that everyone's talking about. Let's just take a step back here and understand pivot a little bit more. A pivot basically means that the Federal Reserve goes from raising rates at a very fast rate to slightly slower, which is stage one. I think we can clearly say that the Federal Reserve is pivoting right now. And then they move to how are we going to risk mitigate the markets. Now, what the market did was it realized the other day that potentially Jerome Powell and the Fed have moved very quickly to stop inflation, and maybe they have. And it looks like inflation is turning. We don't know if it's sticky yet. That is, it holds at a higher rate above 2 to 3% for too long. But what is clear is that the economies around the world are sick. And that's what this blue line represents. Not only will there be multiple rate cuts, but the rate cuts are going to be record rate cuts moving forward. As in, they're going to need to continue to rate cut and rate cut and rate cut to try to support the economies around the world, and more importantly, the companies that are now going to be coming under fire. 2023 is all going to be about earnings. At least that's our expectation here on the channel. And stage 2 or 3 of effectively the Fed pivot is going to be reaching terminal rate, which is still expected to be around 4.8% at the time of this recording. And then we're going to see the first rate cut. Now you might say, well, Tom, that means the bottom's in. Well, historically, the Federal Reserve rate cuts due to a sick economy. That's not a good thing. And while that may mean that you can start going and looking for bottom hunting, at least that's what people generally believe, it's not traditionally until some of the rate cuts have come through that we actually get the turn in the market. So keep that in mind. We'll do a study on it later on this week, talking about Federal Reserve rate cuts in the future, when they've pivoted and what it's meant. But these rate cuts and the speed at which these rate cuts are happening is all got to do with the yield curve. And we'll look at that later on today's video. But remember, this is a sickness that's been created due to pushing interest rates beyond what we even thought was possible in 2020 and 2021. 5%. Let that sink in. You know where we were only a year ago. It's almost amazing the economy is even holding up at all. Now, to celebrate, of course, Christmas, we are doing a giveaway. Links in the description down below. You can definitely check it out. It's totally free to enter. If you're interested in doing so, you'll see there's about 7 days left to put in your entry, and we're giving away one of each one of our courses, upwards of value of around $3,500 for group mentoring with myself. So if you're interested, why not go and check it out? Look at the links in the description down below, and this is a bit of a Christmas gift, and also to apologize a little bit for, of course, that Monday stream where unfortunately we weren't able to make it. Do remember next Monday, big one. It's going to be 2 hours long. I'm going to be going into some in-depth market analysis as well while we see whether this market turnaround is actually real or not. Because if it continues, then it could present great opportunities for both bulls and bears in the future. So let's talk about dumb money confidence. What have we seen in terms of similarities with last time? Well, dumb money has gone back over the 0.6 level. And this just basically means that retail investment has picked up again. That's an easy way to think about it. Retail investment inflows is on the rise, and traditionally this has not been a good sign for 2022. There is one change though, and that is that while this was generally marking close to the peaks of the market and could be again, that it has certain inflows that are a little bit different to last time. So when we generally see the S&P 500 and it has less than a 1% gain for the week following the dumb money crossing, which was again over a week ago, we tend to see very poor market conditions for the next week, 2 weeks, 1 month, 3 months. That's what we had the last 2 times. Now, this time around, we actually went about 1.3% up. In the limited data points that we have from this point, it traditionally wasn't as bad. In fact, 100% of the time, 1 month later, we were actually bullish. Of course, these are stats to be broken, but it is interesting that we were over 1% gain following the cross. That didn't happen last time, and traditionally, when it has happened, it's actually marked okay points. Keep that in mind when we're discussing these things. I still think there's a great chance, though, that the bears take control. But these are the real stats. We might as well share them and talk about them together. Now, if we're talking about 2023, again, following midterm horror years, usually we get much better pre-election years. And the 2 best sectors that have historically given the best percentage returns have been small caps and discretionary. Take of that what you will. Now, could that mean that we still fall off during the start of 2023 and come in strong at the back end? Absolutely, it could. And do remember, we're not expected to see the rate hike top off until around March to April of 2023. So earnings after that point and around that point are going to be important. A lot of people believe that's where we'll really see whether we've put the bottom in on markets around the world. Seasonality would dictate that we should be going into a period of weakness here. We've started December off relatively okay. We've now begun a little bit of a sell-off. Technically, it usually sells off to around the 14th to the 16th of the month, and then we get what we call the Christmas rally or the Christmas cheer. Will it come again in 2022? Well, we're not sure yet, but of course, this is an important date to set because options are going to expire around the 16th. We'll look at that as we go through the charts. Speaking of charts, let's begin our first one. This is definitely one for the bears. We've reached underneath 20 on the VIX. We're obviously now back above 20, 20.76. People that were trading the VIX might be happy with that move, up 8.86% on the Monday close. And you can see here that the previous highs have been put in on the markets around the time that we've reached 20 on the VIX, and the previous lows have been kind of synonymous with 35. Now, one difference, and the reason we like the VIX is because when we look at the volatility index, traditionally, markets tend to bottom with a capitulation or a maximum fear. That's not something we've seen in 2022 so far. And as you scroll out and you go all the way back to 2008, the global financial crisis, is there a similarity here? Yes, there is. And not many huge rise levels that go past 35. Then all of a sudden we have this massive spike that creates the maximum fear. That creates that buying opportunity. You couldn't, of course, necessarily predict that everything was going to get better, but it did. And then we moved around. So you want those kind of high VIXs, not necessarily as high as those went, but sometimes you want to see a 45 plus VIX and it can help us out. So again, for the bears here, the data states one thing, and that is that we're seeing a little bit more call action coming into the markets. People are feeling a little bit more confident. The Fed's pivoted. They're feeling better about the world. And all of a sudden, we're seeing puts start to decline in the markets and become cheaper. And of course, calls going in. So this is a bit of a contrarian indicator. When we see the PCC, that is the put call ratio, lower, it means a higher level of calls are entering into the market. Again, that's what we've had over the last couple of sessions. Another point is that when the Fed has tended to pivot, whatever you want to think of that is, let's say slow down in rates, hiking is what they're doing right now, bonds have come back into focus because bonds like that kind of stability. We've already seen TLT, which is the 20-year Treasury bond ETF, start to recover. We've also got LQD, which is corporate bonds, starting to recover. So while these bond markets are recovering, part of the reason is because they're smelling out those huge cuts in the future, and they're saying, oh, this is pretty tasty for bonds. It's not necessarily great for risk assets such as the stock market. Again, historically, Fed pivots once they've started to cut. Soon after that, we've seen the bottom, but usually not before. At least this is what history tells us. Again, subscribe if you want to check this out in the future. What about high yield bonds? Well, high yield bonds dropped in line with the market. Again, this is maybe one of the better indicators right now because high yields have a lot of zombie style companies in them. So we're looking for, is the economy really sick or not? If they're in line with each other, that's good. If bonds theoretically like this one are just recovering massively and the stock market's going down, I would tend to trust the bonds about the market being positive over that medium to longer term. Let's move over to the US dollar. Did we see some changes here? Yes. Well, we've tested again into this supply level and we bounced straight back into that zone. Very strong moves here throughout the last couple of sessions. And we've actually put a new high in here. So this is a new high past this one. If the market pulls back down to, let's say, a 104.50, 60 area, you would have to think that buyers may recommit to the US dollar trades here. Remember, we are still at the critical level of these previous lows. It's not necessarily turned around or anything like that yet, but it's still in that accumulation. And dollar index showed the first signs of some strength. Now, when we coincide this with something like gold, and we scroll down here to the daily, you'll notice these boxes that we've had before were rallying, then we made a new high, and then we dumped quite a lot lower. Let's have a look now at the 2 hour just to see this. So we probably expect a bit of a recovery, maybe some problems around this price here, which would be around that 17.95 area. And if rallies do ensue with gold, which I guess we would expect, weakness in the US dollar, strength in gold, this will be the decision point for the bulls and the bears. The trend has overall been up. We've reached the critical levels. We've made higher highs. We've dumped past certain previous demand areas. And now we rally and potentially find sellers in here. So I think gold is what I would call neutralized to maybe even on the sell side at this point, even though our medium to longer term outlook still remains very positive for both gold and silver moving forward into 2023 and a potential year of even stagflation. Notice when you look at the economies right now, if we look at something like any of the real metals, like we look at materials and mining or any of these things, this has been what's pushing up these stock markets recently. And that's because pretty much the market has bought energy, it's bought commodities, metals, these types of markets have been the strongest, and also things like healthcare and defensives, because this is the old economy or the stagflation plays coming through. If you're not familiar with stagflation, definitely check it out. We'll do another cover later on the videos, because I think that's probably what's been moved into the most. Let's have a look at oil. It came back down to this little 77.50 area. We talk about weakness due to this low being formed. It rallied, it sold into this area. This is where you want to see strength come back in for the energy plays. Oil is at a theoretical demand now. It has to find buyers straight away. When you talk about oil versus oil stocks, I think they're a little bit different. Oil stocks do look a lot weaker. Like you look at this, we've talked about the distribution, and if you check it out on the daily, it doesn't look super strong for oil stocks. I could see them falling down into the 80 area for XLE, possibly a little bit of a pullback here in oil stocks, lower highs leading into this sell-off, showing us that demand each rally was weakening. And that's something that's very important. We've been talking about this now for multiple weeks, and that was a big session sell-off, 3% down on oil. It was leading the charge on the decline. Tesla was also pretty weak. Consumer discretionary not doing so well. The American consumer is very sick. The Fed clearly smells this out. That's why they're slowing the rate of hikes, because they know they've done damage. They're trying to figure out how much damage they've exactly done to the world economy while stopping inflation. We also know they're there to try to stimulate the economy in the future. This is going to be a balancing act for 2023. It's going to be tough to read. So here we have Tesla. Is it back down to demand level? Yes. Is it potentially an inverse head and shoulders? Maybe. Left shoulder, head, right shoulder. Where's the trigger point? That magical 200. No surprises there. And at this stage, we're coming back. So if the markets recover, of course, you expect buyers to come back in here. If it does fall off, potentially a gap close and some buyers recommitting themselves around that 170, 173. And if we make a new low, we've got to suspect that 136, 126 is coming for Tesla. So at the time of this recording, we're on a minor demand zone, a minor support with some buyers potentially coming in. When we know it's a bit more commitment, it's probably going to be past 200. And then we see hopefully a move to 230. That's not what we've currently got right now at the time of recording, though. It's a minor demand. Be tough and be very, very careful out there. Apple also found a little bit of weakness in the weekly here so far. You can see the daily rejection, shooting star style candle. New low could open up that 140 area for Apple again. Weakness coming in. Series of lower highs also coming through recently. So Apple, not so strong. And it's one of the most important stocks in the market. Semiconductors also usually a very strong sector. Not so strong here in the markets. Still consolidating, still potentially looking towards that short end. We've got alerts set just in case. That's going to be where that straw breaks the camel's back and suddenly markets start to weaken fairly heavily. Another one of our readings is consumer discretionary versus staples. Another bad day for it. This shows us that the American consumer is quite sick. The market's smelling it out. Traditionally, most rallies of markets have begun with this sector doing better. That is the American consumer and also semis and also technology. And that's not what's been happening here in the last couple of weeks during this rally. It is a cause for concern, and it just shows again that the expectation is that maybe valuations will have to be compressed more on growth stocks. That's why they're not leading the charge. AMC versus the market. This is something we've used in the past to figure out the toppings. And you might disagree with this, but really what it's showing us is that when people get a little bit greedy and they feel a bit better about the world, what do? They tend to go into risky assets. This is obviously one of the more risky assets. We see squeezes coming through. Everyone gets more comfortable and markets are allowed to do that. We didn't get exactly the same kind of squeezes we've had in previous rallies here, but we certainly did still see a 70+% increase in AMC stock, and that's now started to reverse. So again, is it in line with what we've seen before? Theoretically, yes. Something I thought I'd bring to our attention. Old economy versus new economy, another strong day for the US 30 versus the US 500, and that's a big switch. When we see the old economy doing better than the new economy, that's important. And basically that's where we find ourselves at the time of this recording. It means that it's not a growth style recovery. Let's have a look at the Qs coming into a kind of trend line, not necessarily super strong, bit more of an accumulation than last time. I think it's important to always understand, usually when you're looking at base fake rallies, you're looking at strong pushes that look like just huge V-shaped reversals, not necessarily slower pullbacks like this one. This usually shows more of an accumulation. So a lot of people are calling bottoms because of this. I don't blame them. It's definitely a weight of evidence thing. QQQ's looking a little bit stronger. The NASDAQ struggling with the 12,000 level that we've talked about several times, weakening off this zone. And we can see here, long leg doji, indecision, equilibrium. It's clearly a point of concern. And what we're really looking for here is more the S&P 500 leading us to show that weakness is in. See the weakness here. At the time of recording, we found no new low, but certainly important to look at. S&P 500, you guys know the drill. This is a massive trend line. It's stopped everything in its tracks this year so far. We have quite a lot of indicators that are sitting around this area. Gaps, 200 daily, as you can see here, sitting around that area. We also have 61.8 to 78.6 fib retracements, very, very strong. I'll just put one on the chart so you can see it. There's one there. And you can see those 61, 70, 78.6 kind of levels getting close. And if we move over to the US 500 futures, what you'll notice is a new low was made. So we had the high, like a low, a higher high, and we had a lower low. Then we pulled back, pushing us into that short idea. We rallied through the session, came back up to this level, and then we've made a new low. Again, weakness around a known entity or known zone. I think to really solidify that this market is weak, we need to take out this green box. And that's showing us that, yes, the market has really reacted to this level. It's willing to go down. It's breaking through all those buyers that were showing here in the 39.40, 39.50 zone. And then they're looking towards, of course, sell-off potential. So yeah, I think this is probably the most likely at this stage. We're still open to the idea of one last push or a push coming up to get all of these weekly levels and everything else that's up here. I think that will convince a lot of people to go long, but we're somewhere in this vicinity. And for options traders, this is what they want to see. They want to be in this area and saying, okay, I'm seeing this weakness. Next 24 hours, you'd have to still think weakness is the bigger play, but I would probably suspect something like this is more likely, testing this area and finding out whether we've got it. If it does rally, it should rally to a new high and find problems around the 41.10 to 41.40 zone. Let's look at options moving forward. Trillions of dollars at stake. Open interest amount for December is massive. We have calls all over 420. Be careful at that zone should we get there. You can see here, everyone wants to be on 420. 400 starting to become a bigger strike. 380 on the bottom end. We know 375 is where that gap fill from the inflation number sits. So the market can easily get there, but it doesn't probably want to expire there. So between December, although this is wide, we kind of know between 380 and 420, the market should theoretically be in this zone around that period, with 390 being the max pain. So it seems like based on options, the higher it goes here, the more likely it is to really want to come back down to like that 380, 390 level by December the 16th. Now, remember that date. That's theoretically somewhere around the bottoming of the Christmas rallies of December. So it's a really interesting time here in markets, and certainly we're starting to build that data case for it. Bitcoin, yeah, decent rally here. Certainly on the last recording, we got that pullback that led to a rally. But look at this, another wick rejection. Could this be some kind of distribution that was like a max pain false breakout? If the stock market go down, expect Bitcoin to also go down. Let's have a look at the defense here. Pretty strong buying coming through here. Recently, it's been a lot stronger than it has been. We thought that this would probably be where the buyers came back. They recommitted. Weakness, if we start making new lows, again, we've got an alert sitting here at about 16,750-ish. If that makes a new low, then you have to think that Bitcoin's going a little bit more lower or a little bit lower for now. So yeah, daily's not looking so good. Smaller time frames defending as best they can. And you can just see the buyers are recommitting themselves constantly to this current price, which sits around that 16,850. Good luck out there. It's a tough market at the moment in the crypto world. Ethereum also doing a very similar thing. And you can make arguments for it to be basing for a nice big push to try to fill some of this. And yeah, look, it's all about, does it make a new low, or is it going to rally off this exact area around where we are at the time of this recording? For the week ahead, let's take a look at the news. We'll just quickly zoom this out. Basically, we see here that we have some news coming through. It's not a news heavy week, so that's important, but we have the core PPI numbers and the prelim UOM consumer sentiment Friday, December the 9th at 10 a.m. and 8:30 a.m. New York time. So that's going to be important to watch. If you enjoyed today's video, then make sure, of course, to subscribe, smash that like button, and do remember, if you're interested in entering the FX Evolution competition, it's completely free to do so. Then just jump over to the links in the description down below, put in your details, and then, of course, we'll be drawing that just before Christmas on December the 15th. So it's going to be exciting. If you're interested in getting something for free, why not give it a shot? Thanks so much, guys. See you in the next one. Bye for now.